Welcome and thank you for joining us for this Drewry webinar event looking at the impact on container shipping from the Middle East conflict. I'm Simon Heaney, Senior Manager of Container Research at Drewry and the editor of our Container Forecaster report. And joining me today is Philip Damas, our Managing Director and Head of our Supply Chain Advisors team. The presentation will take about 20 minutes. There'll be 10 minutes for Q&A left at the end. You can ask questions anytime during the presentation using the panel on your screen. And at the end, all registrants will receive an email briefing shortly afterwards. That will include a video link to the recording, a Q&A summary, PDF copy of the slide, and you'll also receive free access to the spotlight report we did on the Iran war in the last container forecaster. So I will cover how the container market is adapting to the conflict and what the lasting effects might be, while Philip will look at ways that cargo owners, shippers can protect themselves from rising costs. So this has been a very difficult webinar to prepare for. The situation in the Middle East is extremely dynamic and has some very unpredictable main actors. The price of oil continues to jump around depending on the prevailing sentiment on any given day. And this slide here shows you the development that we track in our Drewry On Demand platform. So we have, you can see bunker prices here for a variety of different major hub ports around the world, giving you a very quick snapshot of how things have changed. But as many sort of war game simulations will have anticipated, is the Strait of Hormuz, through which so much of the world's seaborne oil trade passes, has become the central flashpoint of the conflict. Iran has unleashed its most potent economic lever by turning it basically into a no-go zone unless very expensive tolls were paid, and it is not likely to give that up very lightly. And so with so much happening, I think it's worth a quick recap of where we stand today. We're now on day 8 of the 2-week ceasefire that was agreed on the 8th of April. High-level diplomatic talks that were held in Islamabad, Pakistan at the weekend ended with no agreement reached, and on Monday, the US imposed its own naval blockade of Iranian ports, not of the Hormuz, as Trump said initially, but of Iranian ports. So there is a lot of noise and bluster. But what there isn't yet, at least, is a clear timetable for resolution, and there is clearly plenty of scope for re-escalation. So in our view, until there is something substantive, something that is acceptable to all sides, that holds some degree of permanency, the situation and the risks for container shipping won't change. Carriers really don't have any alternative but to wait and see and continue serving the Middle East in the patchwork fashion that they quickly adopted after the start of the war at the end of Feb. So the outperformance of container shipping equities relative to the broader market since the onset of the conflict highlights a sort of very familiar dynamic in that disruption is generally perceived as being supportive for carriers. However, not all disruption is equal. So unlike the COVID period, where severe supply constraints coincided with a surge in demand, the current conflict carries a meaningful downside risk to demand also. So any escalation in military activity is going to weigh heavily on global trade and therefore in turn carrier profitability and their share performance. Now, although the Gulf is less central to container shipping than to energy markets, the Middle East, as you can see from this slide, accounts for less than 5% of overall world container port throughput. Disruption, higher costs, and increased volatility are already evident, and these risks will intensify depending on the duration of the disruption. But because we don't know how long it's going to be before Hormuz is fully operational again, Drewry has taken the position. We've decided to sort of look at two potential scenarios and what implications they will have for container shipping. So our first and our base case scenario is that there will be a short disruption of the strait that will last until the end of June this year. So essentially a first half of the year situation. And the second alternative and more pessimistic scenario is that there will be a prolonged disruption of the strait that will last for 12 months, i.e., through till the end of February next year. Now, the description of these two scenarios has been slightly amended from what we said in the previous container forecast report at the end of the March, and that's really just to reflect changing events since then. But in any case, under our base case assumption, a short disruption is going to result in little more than a temporary spike in freight rates driven by higher fuel surcharges. There'll be a modest dip in global volumes, particularly into the Middle East. And there will be a familiar demonstration of supply chain resilience. A prolonged disruption, however, will be far more consequential. So if we were to see a 1-year disruption that drives oil prices up to, say, $140 or $150 per barrel, that would deliver a much more severe shock to the global economy, triggering a toxic mix of energy and food shortages, rapid inflation, and very possibly recession in import-dependent economies. In our view, under that scenario, global trade growth would contract and geopolitical tensions would intensify as the major powers scramble to secure alternative supply routes and to access strategic reserves. But one consequence of successive global disruptions, from COVID to the war in Ukraine to US tariffs, is that container lines have become increasingly adaptable. Trade finds a way, and liners have responded to this latest crisis with a combination of caution and improvisation. So we have split carriers' response into three phases. Phase one, complete withdrawal from the Gulf. Phase two, in two concurrent parallel parts. 2A is reintegration of the Gulf via alternative networks, and 2B is to prepare for escalation scenarios. So in phase one, carriers suspended bookings and services almost immediately. Cargoes bound for the region were discharged at the nearest safe ports. Insurance remained available, but it was often a prohibitive cost. But in practice, it wasn't insurance, but security concerns that halted shipping. And after that initial shock, carriers moved pretty quickly into the second phase, typically within 1 to 2 weeks, to restore flows into the Gulf via indirect solutions. So a lot of, mini land bridges, etc. And while not a dominant container market, the Gulf is a critical region. Its economies are heavily dependent on imports of consumer goods, machinery, construction materials, and food. And its ports function as big transshipment and bunkering hubs too. So, as I say, multimodal feeder service and overland corridors were soon established, using both carrier-controlled and merchant haulage options. Bookings are now reopened, but services take far longer, they're more complex, and much more expensive. And we've seen a network or a ring of alternative hubs emerge outside of Hormuz that enables cargo to be rerouted into the region. But these hubs are still within striking range, and they're also subject to war risk surcharges, so they're still very expensive. And if we were to see any significant disruption at these nodes, there's going to be even further contingency measures that will have to take place, including diversions to substitute ports a little further out, such as Colombo or Narvasheva. But the result is a highly dynamic and a fragmented operating environment. And for the duration of the conflict and potentially beyond, if mine clearing operations are still required, container shipping to the Middle East, in our view, is likely to remain indirect and disrupted. Um, but as I said, at the same time as plugging the Middle East back into liner networks, carriers had to simultaneously prepare for escalation scenarios. And I think fuel is at the topmost of their thinking. It's becoming increasingly both a cost and a strategic risk to shipping lines that necessitates contingency planning. So as I showed you at the beginning, global bunker prices have risen by 60 to 80%, and there's significant regional divergence. Demand has shifted away from Fujairah, located just outside Hormuz, but within the expanded insurance war risk zone, towards safer hubs such as Singapore. But supply is tightening there as a consequence, and it is driving uneven price spikes. And major carriers were very quick to announce emergency fuel surcharges, and we expect that this will continue if bunker prices continue to head upwards. Now, the risk of bunker shortages is real, but it's not an immediate threat in our view. Um, and if the conflict persists, we think the sequence of market adjustments will follow this sort of pattern. So first stage, there is reduced Middle East supply. We're already seeing that. Second stage, refiners are going to source alternative crude. Again, we're seeing that. The third stage, there'll be a drawdown of inventories. Again, I think that's where we're at now. And in the fourth and fifth stage, so fourth stage, there will be you'll start to see net supply deficit and product shortages. And in the final stage, stage 5, there will be demand destruction. So in our view, we're now currently at stage 3. And if we were to move through to stage 5, that's still a few months away in our view, because there are sufficient, or there's quite a substantial amount of inventory buffer. But regional imbalances will mean some import-dependent economies are already experiencing that sort of stage 4 conditions, and we have seen that they are introducing emergency and energy-saving fuel preservation measures already. So in our view, widespread vessel layups due to fuel shortages represent a late stage outcome, stage 5. And in the interim, we think carriers are more likely to rely on operational measures such as slow steaming across the global network to preserve fuel. And this will have a knock-on effect in the fact it will reduce effective capacity in all trades, not just in the Middle East. And as mentioned, this crisis also affects demand prospects. A rule of thumb is that every $10 increase in oil prices reduces global GDP growth by 0.1 or 0.2 percentage points. So if we were to go to $150 per barrel, that would imply a potential downgrade of up to 1.6 percentage points relative to pre-war forecasts, and that would be enough to tip some economies into recession. And in the last edition of the Container Forecaster, we downgraded our expectation for container port throughput growth this year to 1.8%. It had been 2.2 in our February update. Any further escalation in the conflict will undoubtedly force a bigger downgrade. And under our pessimistic case, longer disruption scenario, we think that global port throughput demand growth this year could fall to between 0.5% and 1.3%. So further scope for downgrades, clearly. But for now, liner disruption remains manageable, just about. Global container volumes have not collapsed. Trade flows have bent rather than broken. But even if the Middle East conflict stabilizes and Hormuz reopens within our base case timeline, it has already exposed some structural vulnerabilities in the market. which could lead to lasting changes, not just temporary disruption. Top of the list, in my mind, would be a redesign of liner networks that will try as much as possible to avoid choke points. We've already kind of experienced that with the Houthi attacks on shipping that happened started from the end of 23. So we saw networks then shift from being, cost optimized to becoming more risk managed and resilience focused. And I think this may become a more permanent feature in the future, and will, as I say, lines will look to reduce their dependency on any single corridor, whether that be Suez, Hormuz, or the Bab al Mandeb, or anywhere. They, really want to avoid finding yourself in this pinch point situation. I think the conflict could also accelerate the trend towards more near shoring strategies, so that shippers will want to avoid longer and those less secure routes. And I think if we get to this point where there is much more diversification of routes, it is going to require a greater willingness on the part of customers to accept longer journeys, which will have a knock-on effect in terms of increasing demand for ships. You need more ships to service longer routes, and therefore that will shape new build and demolition strategies of carriers. You could argue that carriers and ship owners have already been preparing for geopolitical disruption by ordering a record number of container ships over the past few years. Um, I don't share that view, but you could argue that. And if this pessimistic scenario plays out, it could well be that the pace of new build contracting will stay higher for longer. That's all from me. I'm now going to hand over to Philip to give a shipper's perspective.
Thank you, Simon, and hello, everybody. So I would like to share with our customers or interested industry stakeholders on this call extracts on the latest developments concerning the Middle East, carrier networks, business conditions, and so on, as seen from the viewpoint of exporters and importers. So first, as shown on this slide, our databases confirm that more than 48% of Gulf mainline capacity was cut between the end of February, meaning pre-conflict, and the end of March. So some carriers are still showing Jebel Ali calls in their schedules, but they rarely send their ships there. You can see sort of a big cut in Gulf capacity. However, there has been a small increase in mainland capacity to the Red Sea, which you see in blue on the chart. Moving to the next slide, shippers are also in a wait-and-see mode. Yes, bunker surcharges have gone up a lot, as many shippers know, on all routes, and spot rates have more than doubled on the Gulf-connected routes, as carriers develop new, more expensive services, as Simon mentioned. But if you look at the concerns of shippers today, the key concern remains safety of cargoes and ships, not only in the Gulf, but also in the Red Sea. And related concerns are port congestion, which is now building up in parts of the Middle East and South Asia, extending transit times. Now moving to spot rates on the next slide. Spot rates from China to Jebel Ali via transit in Khorfakan now cost 3 to 4 times what they cost before the conflict. You can see there the big bars on the right. So it's getting much, much more expensive to serve the Gulf. But looking ahead, we at Drewry expect that competition between carriers and forwarders will drive these Gulf rates down, and we will monitor them in the Drewry Container Freight Rate Insight tool in particular. Now, moving to the next slide, based on the work that Drewry does for shippers, here are some examples of actions which we know from discussion with shippers are important on their agenda, and also the key question that is asked about whether there will be overcapacity or not. So for example, you have this question of out of control fuel surcharges. Our view at Drewry is that the marine fuel prices will stay above pre-Iran conflict for many months, depending on the scenarios. And some carriers will slow down their ships to economize on fuel. The other issues are geopolitics and uncertainty. As we discussed, it's really the latest in a long series of increasingly frequent geopolitical disruptions. And the last issue is overcapacity. So what we see concerning the surcharges is that more shippers are moving to what we call a standard bunker policy based on an independent index, which can avoid some of the unilateral BAF increases of carriers. So we recommend that to shippers on this call. And we also see concerning geopolitics that shippers should continue to think about monitoring risks and diversifying routes or diversifying sourcing to keep resilience in their supply chains. And we at Drewry look at risks such as the Strait of Hormuz and Suez Canal when assessing a shipper's risk exposure. But to end on a positive note, Drewry has determined that in our base scenario, the spike in spot rates from the Iran conflict is going to be much smaller than during COVID. And we see, again, in the base scenario, no substantial impact from the Iran conflict on the supply-demand balance. So it still makes sense for shippers to go to bid now and expect lower contract rates than last year, despite all the geopolitical complications. And I would just add that there may be a different treatment for rates or lanes to the Middle East because now they are so disrupted. It's probably better to exclude them from bids. So that's it from me.
Excellent. Thank you very much, Philip. Right, now we will switch to the Q&A segment. We've had loads of you put them forward, so thank you very much. We should try to get through as many as possible. I'm going to start with one that actually came in prior to the webinar. It came in yesterday. Someone is asking about which areas, in terms of bunkers and oil, which areas will be hit by oil shortages following the Strait of Hormuz closure, which areas might be next in line, and also what mitigation options do countries, locations, and carriers have to deal with this. So I'm not an expert on tankers and oil. In fact, we will be doing a follow-up webinar in a couple of weeks that will include, I will be part of, but also my colleague who is much more of an expert in tankers and oil, does our oil forecast, will be there, and he will give you a much more expert opinion. But from my position, what I can say is that the largest share of oil flows go to Asia, especially China, India, Japan, South Korea. These countries source 60 to 80% of their imports from the Gulf, and they have fewer sort of substitute options, and refining systems are often configured for Middle Eastern crude, so it's very hard to switch grades quickly. So it's Asia that is suffering the most. And as I mentioned in the presentation, a number of countries are introducing energy saving measures to mitigate the impact. I can't sort of go through them all now, but if you look at the IEA website, that's a really good tool that showcases all the various measures that are happening around the world in terms of how to sort of soften the blow from this conflict. Other regions, such as Europe, are less directly dependent on Hormuz for oil, but obviously they still have to compete for displaced energy sources, and we are feeling that the pricing shock too. From a container line perspective, well, they can shift their bunkering from Gulf hubs to others, which is already happening, which is why we're seeing squeezes in places like Singapore. But operationally, as we've mentioned, they can slow down their ships to preserve fuel consumption. And if supply gets really tight, I think we can expect to see more blank sailings coming in, and even idling of ships on a longer term basis if it becomes a real problem. From a cost perspective, clearly they have no choice but to pass these on to shippers with higher BAF surcharges, although I think carriers could do a far better job of detailing these cost exposures to customers to justify uh, those surcharges. I think that's been an issue for a number of years, not just this. Let's move on to another question. Let's see. Someone is asking me, how do we see the impact on time charter rates if the crisis goes as per your worst case scenario? It's a bit of a long question, but I think that summarizes it. Okay. Well, the time charter market has been disconnected from freight rates for a good year or so now. They usually, historically, they move roughly in parallel, but it has been disconnected, and that's essentially to do with the shortage or lack of availability of feeder ships um, that have been repurposed for the Russian trade from Asia, and also from smaller pool of ships, because a lot of carriers have been buying up second-hand ships. So the charter market is operated slightly to kilter. Uh, this is even whilst we've had record deliveries of new ships. So the charter market has been very robust. We still think it is due a correction because of the overcapacity in the market, but this could delay that. And clearly, if there is going to be increased demand for feeder ships to continue serving, to support the Middle East sort of multimodal network, that's going to potentially see time charter rates go up in the short term as well. So I think it's still slightly unknown, but I think the pressures probably suggest that it will stay elevated relative to freight rates. Let's see what other questions we have got. Maybe I'll find one for you, Philip.
There's one here. Which ports are likely to benefit from the current war, and whether this creates new investment potential for inland logistics within the Gulf nations and terminals outside the affected straits? So I could take that one. So we see potential for ports located in the Red Sea or in the Eastern Mediterranean, like Aqaba or some of the Turkish ports, to serve the northern part of the Gulf or the northwest part of the Gulf. And also, I think Jeddah could get a bigger foothold into the Gulf market. In terms of logistics, as we said on the previous document from Drewry, analysis from Drewry, we think really the GCC, the Gulf Cooperation Council, should go ahead and build the east-west container corridor railway that we have discussed for years and years. Now is the time really to realize they need a strategic alternative to the Strait of Hormuz, and that could potentially make a big difference to the inland logistics in the Gulf without over risk.
Great, thanks for that. A couple of people asking if they can get a recording because they were late to attend. Yes, we will send out a recording just after, possibly tomorrow, I suspect. We will send a recording out. Maybe another one here for you, Philip. Do you believe it is the right time to go to market for routes not connected to the Middle East? Example, Europe to US. I'm guessing that's to do with contracting. I'm not sure.
So yes, we do. So do we run some tenders on behalf of shippers, and I can confirm you that current tenders are yielding good results on transatlantic and other trade routes. You may need to have to pay some higher bunker charges initially, but you secure lower base rates on these trade routes. So the overall picture of supply and demand this year being more favorable for shippers is still true.
Okay. Another question here. Do you have a view on the long-term use of Suez? Will it ever go back to pre-disruption transit volumes? This is the million-dollar question. So previously, I don't know how long you've been following Drewry, but our position previously we had actually switched our position from not being able to predict it, so we had it down as a base case that Suez would not be fully reopened until the end of our 5-year forecast. And then we got to the point where carriers were starting, insurance costs had come down. Carriers were testing the route, and we felt like by sort of this time next year we would be close to being back to fully operational. There would be a gradual phasing back in. I think this story, this Middle East conflict, has put that totally on the back burner. Um, I think it's unlikely until this story is fully resolved and that that passage the situation is, as I say, fully resolved and shipping is deemed safe, that we will go back to that. So I think that's now even more difficult to answer. As I mentioned in our sort of long-term impact assessment, I think perhaps Suez will never get back to its full domination of the sort of Asia-Europe corridor. I think that we will see more diversification. So even at that point, we may see some Cape of Good Hope routings remain. So I think that's a difficult one to answer, and we have now pushed it back to the point that because we can't predict when Suez will be fully reopened. Of course, it's never closed, but in terms of operationally, we have put it down as our base case that we will see diversions for the duration of our forecast horizon. Let's see if we can squeeze one more in before we wrap it up. Do you see anything that stands out, Philip?
No, I think we could close. If we have further questions, we can answer by email, can't
Yes,
we?
I think that's the fair thing to do. There is quite a few, but as I say, we can't do them all justice in the time allotted. So we will endeavour to answer all of these as long as they're within scope of the presentation. We will put them together in the email briefing that will come out to you tomorrow. And all that remains for me to say is thank you for attending. We hope you found it of value, and we look forward to seeing you at a future Drewry event. So have a good day.
Goodbye.